If you send money to your children, help a grandchild financially, or move money between your own bank accounts, should you be worried that the IRS is going to tax that transfer? You've probably seen the posts. But here's the important part. A lot of what you're seeing online is wrong. There is no new federal tax that simply applies because you transferred money from one person to another. But, and this is where it gets important, there are real reporting rules surrounding certain transactions, real tax rules surrounding gifts and income, and one major 2026 change involving certain international remittances. So today, we're going to separate the rumors from the rules. I'll explain what happens when you send money to family, what the $10,000 cash rule actually means, why deliberately splitting deposits can create a serious problem, what happens with payment apps, and the new 1% tax on certain international money transfers. And I'll also explain one mistake that can create an IRS paperwork headache even when the money itself isn't taxable. Because the biggest danger isn't simply transferring money, it's misunderstanding what the transfer represents. Before we get into it, if you're 60 or older, retired or approaching retirement, and you've ever felt that keeping up with Social Security, Medicare, taxes, and financial rules is unnecessarily complicated, I've put together something called the American Retirees Money Playbook. It brings together important retirement rules, forms, thresholds, and government contact information in plain English, using the 2026 figures. If that's something you'd find useful, there's a link in the description and pinned comment. And if you're watching on television, you can scan the QR code. Now let's clear up the biggest misconception first. There is no new federal tax on ordinary family transfers. Suppose your daughter needs $2,000 to repair her car. You transfer the money from your checking account to hers. Did you just create a new IRS tax? No. Suppose your grandson graduates from college and you send him $5,000 as a graduation gift. Is the transfer itself automatically subject to federal income tax? No. Suppose you and 3 friends go to dinner and one person pays the entire $240 bill. You send your share through a payment app. That's not suddenly taxable income simply because the reimbursement traveled electronically. The IRS specifically explains that personal payments between family and friends, including gifts and reimbursements for personal expenses, aren't taxable income merely because they are sent through a payment app. And moving your own money isn't a taxable event either. If you have $40,000 in checking and move $15,000 into your savings account, you haven't earned $15,000. You've simply moved money you already owned. The same basic principle applies if you move your own money between 2 banks, transfer funds into an account you own at another institution, or consolidate accounts. The transfer itself isn't income. But there is an important distinction. The IRS cares about what the money represents, not merely the fact that money moved. If your friend sends you $300 to reimburse you for a vacation expense, that's one thing. If your friend sends you $300 every week because you're providing a service, that's something very different. The payment method doesn't determine whether something is taxable. The underlying transaction does. And that distinction is going to come up repeatedly throughout this video. For 2026, the federal gift tax annual exclusion is $19,000 per recipient, per donor. That means generally, you can give up to $19,000 in qualifying gifts to one person during the year without that amount counting against your lifetime gift tax exclusion. And importantly, this is not a $19,000 limit on how much you're allowed to give. That's a common misconception. If you give your daughter $25,000, the IRS doesn't automatically take the other $6,000. Instead, the amount above the annual exclusion may need to be reported on a gift tax return, depending on the circumstances. And that brings us to another important number. For 2026, the federal basic exclusion amount for gift and estate tax purposes is $15 million. So don't confuse gift reporting with gift tax payment. They are not the same thing. A larger gift can create a reporting requirement without creating an immediate tax bill. That's why someone who gives a child $25,000 shouldn't panic and assume they've just created a $6,000 federal tax bill. They may need to discuss Form 709 with a tax professional, but the situation is much more complicated than simply saying, anything over $19,000 is taxed. And there are additional rules for certain types of gifts, spouses, trusts, and non-U.S. situations. So if you're giving substantial amounts to family, especially if you're transferring property rather than cash, professional advice becomes much more important. Now let's talk about the $10,000 rule. This is where the internet rumors usually begin. You've probably heard, never deposit more than $10,000. That's not the rule. You are allowed to deposit more than $10,000 in cash. What happens is that financial institutions have reporting obligations under the Bank Secrecy Act. When a financial institution handles more than $10,000 in physical currency in a business day, it generally has a Currency Transaction Report, or CTR, obligation. FinCEN explains that cash transactions can be aggregated when the institution knows they involve the same person and exceed $10,000 during one business day. And this is the part people often misunderstand. A CTR is not a tax. It doesn't mean you've done something illegal. It doesn't mean the government is taking 10% of your money. It doesn't mean the bank thinks you're a criminal. It's a financial reporting requirement. For example, imagine you sell a vehicle and receive $14,000 in cash. You take the $14,000 to your bank and deposit it. The bank may have to file the required currency transaction report. That's not the same thing as saying the $14,000 is taxable income. The tax question depends on where that $14,000 came from. If it was money from selling an asset, the tax consequences depend on the transaction. If it was an inheritance, different rules apply. If it was repayment of a loan, that's different again. If it was business revenue, that's another situation. The bank's report doesn't determine the tax treatment. The underlying transaction does. So, why should you keep documentation? Because questions can happen. Imagine you deposit $18,000 in cash and 6 months later, someone asks where it came from. If you have a bill of sale, settlement statement, inheritance documentation, loan agreement, or other records showing the source, you can explain it. Without documentation, you're relying on your memory. And that's not ideal. This is particularly important for retirees because large financial events can happen occasionally rather than every month. You might sell a car, sell an old collection, receive money from an estate, receive proceeds from a legal settlement, sell property, or receive repayment for money you previously loaned someone. You don't need to be frightened of a large, legitimate deposit. You need to be able to explain it. That's a completely different mindset. Now we're getting into an area where the rules become much more serious. Suppose you have $15,000 in cash to deposit. You know about the $10,000 reporting requirement. So instead of depositing $15,000, you deposit $7,500 on Monday and another $7,500 on Tuesday, specifically because you want to avoid the bank's reporting requirement. That can be considered structuring. FinCEN specifically describes structuring as breaking transactions apart to evade Bank Secrecy Act reporting or record-keeping requirements. And this is a critical point. The underlying money can be completely legitimate, and the structuring itself can still create a serious legal problem. So don't take the internet advice that says, just keep every cash deposit below $10,000. That's precisely the wrong lesson. If you legitimately have $20,000 in cash, don't play games with the reporting threshold. Deposit it properly. Explain where it came from if asked. Keep your documentation. The existence of a CTR doesn't mean you owe tax. Trying to avoid the CTR through a deliberate pattern can create a much bigger problem. Suppose you transfer $50,000 from your savings account to another U.S. bank. Maybe you're helping your child buy a home. Maybe you're purchasing a vehicle. Maybe you're consolidating accounts. Maybe you're moving money from an old bank to a new one. Is there a special federal bank transfer tax simply because the amount is $50,000? No. A domestic wire isn't automatically taxable simply because of its size. However, banks have compliance and anti-money laundering obligations, and unusual transactions can receive additional scrutiny. That's different from a tax. And again, the purpose matters. If you're transferring $50,000 of your own savings, that's different from receiving $50,000 as payment for services. If you're giving $50,000 to your child, that's different from selling your business for $50,000. The same dollar amount can have completely different tax consequences depending on what it represents. So keep the paperwork that explains the transaction. A simple memo or written agreement can sometimes make the purpose much clearer. Now let's talk about Venmo, PayPal, and similar payment platforms. This is where many seniors are hearing the most alarming claims. Someone says, Venmo is reporting everything to the IRS. That's not an accurate way to describe the system. Form 1099-K is generally used to report payments received through certain third-party settlement organizations for goods and services. For 2026, the federal reporting threshold for applicable third-party network transactions is again more than $20,000 and more than 200 transactions. The IRS says the One Big Beautiful Bill restored those thresholds. But here's the crucial part. A reporting threshold is not a tax threshold. If you earn $5,000 from providing taxable services, you don't get to say, I'm under $20,000, so it's tax-free. It isn't. Income from goods and services can be taxable whether or not you receive a 1099-K. The IRS explicitly says this. On the other hand, if your sister reimburses you $600 for her share of a family vacation, that's not suddenly business income just because the money traveled through an app. The IRS specifically says personal payments from friends and family, such as reimbursements, gifts, or shared expenses, are not taxable income. For example, imagine you sell a personal item online. The platform reports the payment, but you didn't actually make a profit. Maybe you bought the item years ago for $1,000 and sold it for $400. The appearance of a payment doesn't automatically mean you have $400 of taxable profit. That's why keeping records matters. If a 1099-K doesn't accurately describe the tax character of the transaction, you need to reconcile it properly when preparing your return. Don't simply ignore the form. And don't automatically assume the entire amount shown is taxable income. The IRS itself says the type of payment determines how it should be treated on the tax return. Zelle is another source of confusion. People sometimes hear, Zelle doesn't send a 1099-K, so the IRS can't see anything. That's the wrong conclusion. Whether a platform issues a particular information return doesn't determine whether income is taxable. If your neighbor sends you $200 to reimburse you for dinner, that's a personal reimbursement. If someone pays you $200 for repairing their fence, that's income from a service. You can't change the tax character simply by changing the payment method. If the person pays you in cash, it's still income. If they write you a check, it's still income. If they use Zelle, it's still income. If they use Venmo, it's still income. The method of payment doesn't erase the underlying obligation. Now we get to something that really did change in 2026. Beginning January 1st, 2026, a 1% federal excise tax applies to certain remittance transfers sent from the United States to recipients in foreign countries when the sender funds the transfer using cash, a money order, a cashier's check, or another specified physical instrument. The remittance transfer provider generally collects the tax. This is a real tax. But notice how specific it is. It is not a 1% tax on every bank transfer. It is not a 1% tax on sending your daughter money in another state. It is not a 1% tax on moving money between your own accounts. And it isn't simply a 1% tax on every international electronic transfer. The law specifically addresses certain taxable remittance transfers based on how the sender pays the provider. So imagine a retiree regularly sends $1,000 overseas to help a family member. If the qualifying transfer is funded using the specified physical payment methods, the 1% tax could mean $10. Do that once a month, and you're looking at $120 over a year. That's worth knowing. But don't take that as a reason to panic about every international transfer. The exact treatment depends on the transaction and the payment method. The IRS and Treasury have issued guidance and proposed regulations explaining how this new tax works. So if you regularly send money internationally, check the rules that apply to the service you're using. Let's turn all of this into something practical. First, stop worrying about ordinary personal transfers. Sending your grandchild a birthday gift doesn't suddenly create a federal transfer tax. Moving money between your own accounts isn't income. Reimbursing a friend for your share of dinner isn't business revenue. Second, if you're giving large amounts to family, understand the gift rules. For 2026, the annual exclusion is $19,000 per recipient. If you go above that amount, don't panic. Talk to a tax professional about whether Form 709 is required and how the gift interacts with your lifetime exclusion. Third, don't fear a legitimate cash deposit over $10,000. The bank's CTR requirement isn't a tax, it's a reporting requirement. Fourth, never deliberately split deposits simply to avoid the reporting threshold. That can be structuring, and structuring is exactly what financial institutions are required to watch for. Fifth, keep records. If you receive a large amount of money, keep something that explains where it came from. Sixth, understand the difference between personal and business payments on payment platforms. If it's a reimbursement or genuine personal gift, keep evidence of that. If you're receiving money for work or selling goods, track it as potential taxable income. Seventh, if you receive a 1099K that doesn't seem to match what actually happened, don't ignore it. Reconcile the form with your records and report the transaction correctly. And finally, if you send money overseas, pay attention to the new 1% remittance tax and the method you're using to fund the transfer. There is no new IRS tax on simply moving money from one bank account to another. There isn't a federal tax that suddenly takes a percentage of the birthday money you send your grandchild. And there isn't a rule saying that every $10,000 transfer automatically creates a tax bill. But there are reporting systems. There are gift tax rules, there are cash transaction reports, there are anti-structuring laws, there are information returns for certain payment app transactions, and in 2026, there is a real 1% federal excise tax affecting certain international remittance transfers funded with specified physical payment methods. The safest way to think about all of this is very simple. Don't fear the movement of money. Understand the reason for the movement. If it's your money moving between your accounts, document it when appropriate. If you're giving money to family, understand the gift rules. If you're reimbursing someone, keep a record. If you're receiving payment for work, report the income. If you're depositing substantial cash, don't try to hide it, document it. And if you're sending money overseas, check whether the new remittance tax applies to the way you're funding the transfer. The IRS isn't taxing the fact that you pressed send. It's the underlying financial activity that determines whether there's a tax or reporting obligation. And that's the distinction I want you to remember. Because the internet can make a simple bank transfer sound like a tax trap, the reality is more nuanced. You don't need to be afraid of your own bank account. You need to understand what you're doing, keep reasonable records, and verify tax questions from official sources instead of relying on a viral post. If you know another senior who's been worried that the IRS is suddenly taxing family transfers, share this video with them. It could save them a lot of unnecessary anxiety and, just as importantly, help them understand the few situations where the rules really do matter. I'll see you in the next one.